Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host, Shafiq Morton. As always, it's great to be with you. As we all know, February is the end of the financial year and it's also the end of the tax year. And I'm sure you've all been reminded that it's time to top up on your tax-free savings, time to top up because the end of the month is almost with us. But to help us understand the whole tax-free savings environment and the whole savings regime is Sherazaan and Ebrahim Rawoot from Oasis. Ladies and gentlemen, Assalamu alaikum.
Walaikum salam, Shafiq.
Sherazaan, it's your chance to go first today. And as we know, a few years ago, government did bring in changes in terms of tax-free savings and savings, but have there been any amendments to this very important legislation?
Yes, Shafiq. So I'm always very happy to talk about the good stuff when it comes to tax and that National Treasury provides for with regards to these vehicles that they've introduced, such as the tax-free savings account, which I think they brought in about 2015, this was introduced. And also what they had introduced, what we term as tax harmonization, which is across all types of retirement funds. And that brought about incentivizing individuals who want to contribute to the retirement funds. And also these tax-free savings accounts gives investors the opportunity to create wealth for themselves. So there is absolutely no reason why you wouldn't want to take advantage of investing in these types of products that we also offer at Oasis, because you want to be able to achieve the maximum tax savings that you possibly can during your financial tax year, and that's within your tax-free savings accounts.
Ebrahim, literally the crunch question. Have people been taking advantage of these incentives?
I think, if you look at South Africa generally as a whole, and I suppose, it's a common problem among society, where South Africans generally have been at the lower end of the savings rate. I mean, as little as 20% of individuals' household income is going towards some sort of savings, whether it is retirement funds, whether it's savings plans, whether it is unit trust. The problem is that it has generally been very low. Now, you mentioned the tax year end is around the corner, but this has been a process that we've been building up to over the last few months. And it's an annual event, and it's an event where we as individuals have become accustomed to, but yet we find the response has been quite low. Now we need to be fair. There are those individuals that are reliant on the accountant to be able to assess their financial situation, and unfortunately there it goes right through until probably the 27th, in fact, probably the morning of the 28th. And then only that individual is able to commit and say, I can now contribute X amount to a retirement fund. But then there are also those other individuals that are salary earning. The employee-based individuals that have been earning a consistent salary over the year. They know what their taxable income is. They know what the calculation should be. So hopefully, as time progresses and as education on these products become a little bit more clearer and transparent, individuals will become a lot more committed to saying there are advantages and these are the incentives, and we will be able to progress on that nature. But just one of the two key individuals points to mention about these products is, besides the retirement savings, besides the tax efficiency behind the product, is the fact that it also protects you very well. It operates in a highly regulated environment, and Sherazaan, we'll speak about that, but really what is so important is that, it protects you against creditors. If you're in financial difficulty, they're laying claim on your home, they're laying claim on your bank account, your retirement annuity really protects you, and is only a handful of institutions or maybe individuals that could put claim to it. So besides you creating a sizable nest egg for yourself over the years, you're also creating that protection for yourself that this is mine and I will ensure that it is mine to enjoy at retirement.
Sherazaan, what happens if I don't make the cut for this tax year in terms of cropping up, for example, is there any kind of rollover scenario?
Yes, Shafiq. So it's important that we, and for the benefit of investors that are listening or watching us today, that we break it down, because it's quite an easy thing to understand. And I'll just be going through a little diagram and basically walking and talking an investor through a type of situation. So you in a retirement fund, whether you're contributing to it through your, where you are at work, through your employee-employee relationship, or you are preserving your retirement savings, or whether you're just contributing to a normal retirement annuity fund. So if we take an example of I'm at my work and I'm contributing to a pension or a provident fund, the employer may deduct contributions to their pension fund of up to 27.5% of taxable income or gross remuneration, whichever is the higher. And now that 27.5% limit applies to the aggregate of the contributions to all your funds. So you remember when I spoke about the tax harmonization? So that's the nice thing. National Treasury has introduced a simple way of harmonizing tax irrespective of what retirement fund you're contributing to. So there's an overall tax deductible limit of 350,000 Rand per financial year. So that's the cap. Now, you spoke about the rolling over. So if you are, you have additional contributions to your income tax, that is, or to your retirement savings, that is carried over and rolled over to the next financial year, subject to those same limits that we spoke about. So those limits of your 27.5% and your 350,000 Rand are capped within your financial year. It still applies, but you are thankfully allowed to carry it over to the next year. So just remember that contributions in excess of the deduction limits may be rolled over to future years, but like we said, is subject to those same applicable limits in those particular years.
Ebrahim, run us through an example of how we go about this tax deduction.
Yeah, I think maybe just before we do that, Shafiq, just to add to what Sherazaan has indicated, in previous years, the calculation was a lot more complicated. There was a lot more you could contribute to your retirement fund because it was based on 15% of non-retirement income. There was one or two other calculations that was used. So it became very confusing. Government and, through legislation and through practice, they've now created a very perfect way for individuals to be able to say, whether I contribute to a pension fund, a provident fund, a retirement annuity fund, my cap is 27.5% of taxable income, and I am not allowed to breach the 350,000 Rand contribution. So if you come back and use that as an example, take someone that's earning maybe a salary, earning a little bit of rental, and use, maybe easy number, 750,000 Rand as an example. And you take a 27.5% maximum contribution, that comes to 206,250 Rand. Now, automatically, you're reducing your taxable income from 750 and you're lessing the 206,000. So 750 puts you in a 41% tax bracket. The fact that you're making the sizable contribution to your retirement annuity or retirement fund means that your tax liability automatically reduces. So without even having to invest the money for a month, you've already created a return on investment just by default on whatever your tax liability rate is. Now you add performance through the investment portfolio that you choose, and I can't see this not being a positive win-win for the individual.
Sherazaan, what are the differences between tax-free savings and tax-free retirement funds in terms of what we're discussing?
Okay, let's just start off by saying they are both great options because you get to save tax, and that's what we want. But the main difference is, Shafiq, is so with your retirement, with the tax harmonization across your retirement fund contributions, like we said, it's your 27.5% of your gross salary or your income tax, capped to your limit of your 350,000 Rand per your financial year. Now, one of the other tax incentivizations that National Treasury had offered, we said, was the tax-free savings accounts. Now, these are savings accounts which ultimately National Treasury introduced so that there could be this wealth creation, so that you could take an opportunity of investing up to your 33,000 Rand per year, and you have over and above this, a lifetime limit of 500,000 Rand for your lifetime. Now, 500,000 Rand is a substantial sum that you are getting absolutely tax-free. And those are essentially the main differences between the two. So the one would just be your normal tax savings accounts, of which we said 33,000 Rand per month, 500,000 Rand over your lifetime, and then your retirement fund contributions. And in order to gain the maximum tax savings, we are encouraging investors, get in contact with our advisors. We offer these products. And one of the new things that was also introduced last year was the fact that you can transfer from these tax-free savings accounts from one to another. And we encourage, if you want to understand it, we are available to take you through the process and help you do the transfer so that you can also actually gain through your tax savings before the end of February this year.
Ebrahim, bearing in mind that February is the D-Day for topping up on all these funds, a special dispensation by the state, but what exactly do we mean when we say that these products are actually tax-free? What does that mean?
Yeah, I think, Shafiq, you are right. And, it's just a few days before the 28th of Feb. So don't think, I've still got a week. And before you know it, look at that. We're already 2 months into
Time flies when you have fun.
The year. Certainly we do. So, yeah, I think, when you use the word tax-free, all of a sudden it should be very appealing to anyone, because I don't think anyone really in their right mind wants to pay that amount of tax. So government created this product as an incentive for individuals to save, but in a very tax efficient environment. So when we say it's tax free, it's not that you are going to be claiming money back from SARS, unlike a retirement annuity where you can. With a tax free savings investment, all the future growth that you are going to earn from that investment, so whether it's dividend income, whether it's interest income, all that is exempt from income tax. Now, that automatically tells me as an individual, if I'm not having to pay tax on that money, that means it's added performance, added return to my investment portfolio. Then there is going to come a point in time when, you would want to withdraw that money from your investment. So if I invested 100 Rand, it's grown to 150 Rand, and I now want to pull out. That profit of 50 Rand is tax-free. So unlike your traditional unit trust savings products where you have a tax called capital gains tax, which is the tax you pay on the profit when you redeem, your tax-free savings product has created this very ideal way of being able to save. So again, I like numbers because it just makes it so much more easier. If you take someone that's investing 100,000 Rand, his investment return is, let's say, 10%. He's in a 41% tax bracket. And you project that 100,000 over a period of 20 years, right? That 10% that is generating as return, he's going to have to pay roughly 41% of that in the form of income tax. So all of a sudden, his net return is actually 5.9%. And when you project that over a 20-year period, his 100,000 is probably only worth 314,000 Rand. It's not a hell of a lot. But look at what a tax-free savings product creates. You're investing that same 100,000 Rand, that 10% return. Remember, we said there's no interest income tax, there's no dividend tax. All of a sudden, the return that you make is the return that's being utilized for your investment. And all of a sudden, that 100,000 now grows to 672,000 Rand. Now, that's over a 20-year period. If you roll this out to every individual in your household, whether it's the husband, the wife, the children, and you religiously commit every year 33,000 per person into a tax-free savings product capped at 500,000 Rand, and you run this for a period of 20, 30 years, you can have a serious, sizable amount of money that you would have accumulated. And guess what? You're not going to have to pay any tax on that money. So, I think it's a wonderful product. But what is important is your tax-free savings gives you the benefit over the life that you are investing. Your retirement annuity, today, you're getting that benefit. Every year, whatever you contribute at your taxable rate, SARS is going to have to refund you or either reduce your taxable liability by what you've made as a contribution to the RA.
Sherazaan, what are the key product characteristics of this tax-free investment product?
So, Shafiq, the tax-free savings accounts, treatment of tax is obviously governed under your Income Tax Act, similarly with your retirement tax harmonization. And the key characteristics of these tax-free savings accounts is that South Africans have this opportunity of investing their 33,000 Rand over the year, and also that lifetime limit that we spoke about earlier. Now, the important thing to remember is that this is per individual and not per institution. So like we said last year, the National Treasury had introduced us being allowed to transfer from, one tax-free savings account at an institution to another. And this incentive is applicable per individual and not just where you're holding everything at one institution. And I think at this point it would be nice to just go also through the products that Oasis offers. So we have the Oasis Balanced Progressive Fund of Funds. We also have the Oasis Crescent Balanced High Equity Fund of Funds, the Oasis Balanced Stable Fund of Funds. We have the Oasis Crescent Balanced Stable, the Crescent range of the Stable Fund, the Money Market Fund, and the Income Fund. And Ebrahim, I know that during the break you were mentioning why it's important for investors to know why we offer this range under a tax-free savings vehicle.
I think, but before we just go into the product offering, and Sherazaan very clearly said it, the limit is 33,000 per year. Don't, as a smart individual, think, I can trick the system and I can maybe give 33,000 to company A in one tax year, 33,000 to company B in the same tax year, because government is going to pick it up, and you get quite the punitive implications, to you is not really worth it. Secondly is, government has also really, encouraged people to save. When tax-free savings products came out, the annual limit was 30,000. It's now moved to 33. And who knows, the budget in a couple of days' time, we might see an increase and maybe even a lifetime increase from the 500,000. So government is playing its part in ensuring that people create savings for themselves in a very tax efficient environment. It is us as individuals that should take these opportunities. Now, yes, 33,000 to some people might sound like a lot. It's not. It's only the annual limit. If I can only afford 10,000 Rand for the year, that's fine. But if we don't make that start, Shafiq, we are really going to lose out not only on the savings benefit, but the tax benefit that is on offer for us. And we saw the numbers. I mean, it just makes so much sense. Coming back to the product range, Oasis has always had this view that risk profiling and life staging is a very important model in any investor's life. So what do we mean by that? If you are young, you're going to work for the next 25, 30 years, your appetite for risk naturally is high, which means you can afford to take more risk and go into a portfolio that's going to expose you more to the market. But over the long term, it's going to reduce volatility. And then you have those individuals, maybe like myself, there's a bit of gray hair, that might want to be a little bit more conservative. And that person might want to say, I need less exposure to the market, and I'm looking more for stability and protection because I've accumulated my wealth over the last 10, 20 years. Now, these are just guidelines that we use, and Oasis has really, in a very easy way, launched certain products all under the balance rules of saying, I've got a balanced portfolio, it has exposure to the market, which is equity, property, and income. And all you're doing is you're playing with the allocation to be able to say, I'm a young person, I can go into a balanced high equity fund. I'm a person that's going to maybe work for the next 10 years. I'm going to be more progressive or stable. And then we added a fourth one to the stable, which is the income fund, where you want minimal exposure and you really are satisfied maybe just keeping up with inflation. So these are the products, and this is where I reiterate, speak to your financial advisor, let him do a risk assessment on you. We all want high return, but we're not prepared to take the risk that follows that high return. And we do understand that markets have been difficult, but with every difficulty comes an opportunity, and that is the opportunity that we are being presented with now. So there are multiple portfolios available on the tax-free savings product. There are the balance funds available on the retirement annuity product. So we're satisfying the life staging and risk profiling model of an individual. And then added to that is the fact that we are creating a tax-efficient savings vehicle for us to be able to enjoy in the future years to come.
In conclusion, Ebrahim, are you saying that anybody and everybody who is trying to save or who is not saving should save, but that anybody and everybody should be aware of this tax-free savings regime?
I think, you know what, it's a process of education. It's a process of learning. These products have been, the retirement annuity products have been around for many, many years. The tax-free more recent. But, you know, through these type of initiatives, we're creating, and through government's intervention to be able to say, this is us playing our part. We shouldn't blame government by saying we haven't heard from them. What are they offering us? They're offering these wonderful, amazing products. It's for us to now go and say, right, does tax-free make sense for me? Are there any negatives? Really, there isn't, because you know, the positive just far outweigh whatever possible negative there could have been. On the retirement annuity, you're protecting yourself from creditors. You're creating a nest egg for yourself. You're substantially reducing your tax liability. And the list just goes on and on and on. So yes, I believe these products are meant for everyone out there, from an infant right to someone that is on the verge of retirement, to someone that's post-retirement. If you are that person that wants to pay less tax, these are the products.
Ladies and gentlemen, shukran. Thank you very much.
Thank you, Shafiq.
And that concludes today's edition of the Focus on Finance show. A special thanks to our guests, Ebrahim Rawoot and Sherazaan Isaacs. Should you wish to watch this or any of our other shows, you can log into the Oasis Crescent YouTube channel or check us out on LinkedIn as well. Should you wish to contact us, you can dial 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm your host, Shafiq Morton. Assalamu alaikum wa rahmatullah.